The legal cannabis industry has unlocked generational wealth opportunities across the country. But the industry's regulatory complexities, constant state of change, and speed of evolution drive confusion for entrepreneurs and investors alike. On this podcast, we'll interview the industry leaders who are shaping the future of the legal cannabis industry to help our listeners understand these idiosyncrasies. This is Cannabis Unlocked, hosted by Key Investment Partners. Good afternoon, everybody, and welcome to the latest episode of Cannabis Unlocked. I'm your host, Jordan Youkilis, one of the founding partners of Key Investment Partners. Today, I'm very excited to be joined by Owen Bennett, the SVP of Equity Research for Global Tobacco and Cannabis at Jefferies. Owen, how are you doing today?
Yeah, I'm good. Thank you, Jordan. Thanks for having me. Excited to do this.
Absolutely. Me too. It's been really great seeing institutional sell-side coverage like Jefferies coming into the space and really helping to get both retail and institutional investors more familiar with the industry. So with that, why don't we start by your background? How did you get involved at Jefferies? And then how did you end up being one of the first banks to cover cannabis?
Okay, yeah. So I'm originally from the UK, a place called Liverpool, which for those that don't know, it's in the north of England, which means I don't have the eloquent tones of the Queen, which you can probably tell. Anyway, so I started life out as a chartered accountant, working at Deloitte. Then I spent a bit of time in corporate finance. Then I worked in strategic finance at Procter & Gamble for a period, before then moving into equity research over 11 years ago now. So for all of that time, I've been covering global tobacco. And then I added cannabis around 3.5 years ago. So the background's picking up cannabis. That came about around 5 years ago, actually. So things were getting slightly dull in tobacco. And so this was really before we saw reduced risk start to get traction, and then the sector started to get more exciting again. So I wanted to broaden my coverage, so I pitched cannabis to Jefferies management. At the time, I was then told no. Fast forward a year or so, I got an email that now Jefferies wanted to pick up cannabis coverage. I assume that given I had shown an interest initially, I was then allocated the role. That then brought me over to the US to be a bit closer to the action. At first, Jefferies were only comfortable with me picking up Canadian names and US ancillary. But then I added the US MSOs in early July last year. So in total now, I cover 15 cannabis stocks, which are 6 Canadian LPs, 7 US MSOs, and 2 US ancillary.
Fantastic. That's a really helpful background. And I think it's a nice segue into maybe it would be helpful for folks who are newer to investing in cannabis to understand what are the differences between Canadian LPs, US MSOs, and US ancillary, and what you mean by those terms.
Okay, so Canadian LPs, US MSOs, they're not too much different in essentially they are cannabis cultivators. And so they kind of cultivate the cannabis, they process the cannabis, and then they make the branded products, which they sell. The key differentiator between the two is US MSOs operate within the US and Canadian LPs operate in the Canadian market. There is then that kind of leads into sort of valuation differences now, which you will see. The Canadian LPs, because they are not doing anything federally illegal, obviously cannabis is fully federally legalized in Canada, they're able to list on major US exchanges. Therefore, they've got much more liquidity. Major institutions can invest in them. US MSOs, obviously, they're still operating in an industry which is still federally illegal. They can't list on the major exchanges, and therefore they list on the pink sheet in Canada, ironically, and major institutions can't invest in them. And so this, I guess, is a key differentiator when people look at Canadian LPs and their financial delivery, which is far inferior to US MSOs. And to that, for instance, I mean, Canada is a smaller market than California alone. but they're trading on higher valuations generally than US MSOs. And this is all to do with that differential. They're on the major US exchanges. They can get institutional ownership. And even on the retail side, I mean, things like Robinhood investors can't invest in US MSOs because they're on the pick sheet, but they can get access to Canadian cannabis. And then finally, US ancillary. These are operators that do not touch the plant in the US, but they play a critical role within the US cannabis ecosystem. So they provide services to the US operators to allow them to go about business in terms of their cultivation and brand building, etc. These US ancillary names, they actually can list on major US exchanges and can access institutional investment. The issue for them right now is that even though they can access that broad institutional investment, which I'm sure we'll kind of go on to in later discussions, they've kind of been thrown into this bucket with the pool of institutional investors that invest in the US MSOs, in terms of it's a very limited pool, and therefore they're suffering from the same issues, even though they're on the major exchanges, which is kind of little liquidity, very small floats, and small valuations.
Yep. It's a great overview, and really appreciate you walking through that. And it's something that we highlight a lot as well, because naturally on the private markets, people are always looking to the public markets as a relevant comp, as they should. And it's interesting because in most industries, you really expect a pretty significant public valuation premium because of the additional liquidity, et cetera, but it feels like you don't really have that in cannabis. And so I'd be curious to get your thoughts on that.
I mean, let's kind of focus on the US operators. I mean, the US market is the holy grail. I mean, that's where all the growth is. I mean, I think even the Canadian companies will concede there's little long-term growth in Canada. I mean, that's why these guys are focusing on international markets, why they're trying to get exposure to the US market at some point. So if we look at the bigger US players, I mean, multiples are overly depressed. I think there's no disputing that. And so you've got an industry here where retail sales in 2021 were 25 billion. That grew over 40% versus 2020. And then these sales should easily reach over 70 billion by 2030. And you can even make a very strong argument for sales by 2030 approaching 150 billion, in my view. At the same time, then you've got ongoing industry consolidation amongst those bigger players. But despite those fundamentals, despite that consolidation, which leads to oversized growth amongst those bigger players, the current average EV to sales amongst these US operators is just around 2.5 times. But I think you can easily make the case for mid to high single digit EV to sales based on those fundamentals we just described. So the issue is, and we kind of touched on it briefly before, multiples right now don't reflect fundamentals, and they're being dictated by technical / regulatory factors, and most notably not being on the big exchanges, which we spoke about, and the lack of institutional investment. And so I know we're likely to touch on this again in our discussions, but unfortunately, in our view anyway, if these technical restrictions persist and they don't go away, i.e. uplisting happens, valuations in our view are likely to stay at current levels and will continue not to reflect the fundamental outlook.
Yep. And, one of, as you talk about like the lack of institutional investors for US MSOs, the statistic I heard recently that really blew my mind was that only like something like 2% of US MSO floats are owned by institutional investors. I'm curious if you think that roughly, equates to what you're seeing at Jefferies.
Yeah, I mean, we've looked at similar numbers. I don't think it's too far off. I mean, when we've looked at it, that's based on public disclosures. And there's certain instances where you have to own a certain amount before you only have to disclose. So I'd argue it's probably slightly higher than that, but I'd say it's probably still less than 5%. And I mean, this is the kind of, when you're assessing potential upside, if we see capital market protections, you don't even have to see full federal legalization. You just need to see the US government put in writing for the big exchanges and institutions, if you choose to list these companies or if you choose to own the shares of companies, will be not liable to federal prosecution. I think that therefore is key to really open up to institutional involvement. And even within that, though, you don't even have to see many institutions come into the space for a material move upwards. I mean, we did some numbers on this. If you look at the current combined market cap of our US coverage, it is less than 5% of the overall US consumer assets under management. So when you look at it like that, you only need a very small proportion of that US assets under management to move into US cannabis, and you're going to see significant moves upwards.
Yeah, I think that's something that we are totally expecting as well, to your point, that there's just going to be this, you almost have this inherent multiple expansion built into any type of legislative reform that increases institutional investor access. And so obviously this is not investment advice, and we can never predict the future, but I'm always curious too, like, what do you think would be the specific type of regulatory reform that would enable capital markets access for US MSOs? Does safe banking get us there? Do we need something with a little more teeth?
Safe banking could get us there. I mean, there's two ways of looking at this from my understanding, and I'm obviously not a legal expert. I mean, it's just kind of my reading around this. There's an upside kind of best case scenario, and that is safe banking language as it is today. It's amended to address capital market protection specifically, or there's an option that safe banking gets additional bills added to it. So it goes through as an omnibus bill, and then one of those additional bills can be specific to capital market protections. And to that, actually, I think it was in early June, there was a bipartisan bill that addressed that specifically. So if we see safe banking language amended, or we see it as an omnibus bill with something like that added to it, then we know that will lead to uplisting. The issue right now, though, with safe banking language as it stands today, it's only specific to depository institutions, and it does not provide protections for exchanges and institutional investment, so capital market protections. What we then have to hope for then is, once safe banking goes through, what happens with the updated FinCEN language, which I think has to happen within 180 days. There is a view that updated FinCEN language could be broader to all financial institutions, and therefore would provide capital market protections. I am cautiously optimistic that would be the case. I know there is also a school of thought that just simply safe banking as it is today will be enough for some of these exchanges to get comfortable. I don't necessarily buy into that. I think we've got to see language in some kind, whether it's in safe banking, whether it's in FinCEN, which is specific to all financial institutions and capital market protections.
Interesting. And so following, let's say, some type of legislation that would allow for that, do you think institutions will be ready right away to jump in? Will they still have issues with it being federally legal? You think it's, somewhere in the middle?
I think somewhere in the middle, so a bit of a mixed bag. So let's say SAFE leads to capital market protections and uplistings. You're not going to see every institution suddenly get involved. So there are many large funds that I speak to, given I cover tobacco as well. And I've spoken to them a lot about this. And even though they want to, they have been informed internally that they would actually need to see descheduling before their funds will get comfortable with it. In saying that, there's also a meaningful number of funds where safe banking and capital market protections would be enough. And then this comes back to our earlier discussion. You don't need to see many of that overall consumer US AUM to come into the space for significant moves upwards.
Yep, totally. And, back to the specific, sectors you cover, you mentioned that you're not really seeing the US ancillaries having a much larger investor pool than the US MSOs. Would love to get, more insight on that.
Yeah, so the hope for, the US ancillaries, kind of very broadly right now, on paper, the outlook for ancillary names is very compelling. So all the leading names play some kind of critical role in the cannabis ecosystem. And therefore, they will also participate, kind of albeit indirectly, in the overall expected growth. Linked to that, they arguably come with less risk. So one, they're not restricted by the state-by-state nature, as they can operate freely across state borders. And two, many of the leading MSOs are these ancillary players' customers. So as we see more consolidation, they grow with them. Given kind of those fundamentals and the fact they can list on a major exchange, on paper, it looks very compelling. You'd think that kind of many institutions that can't invest in the MSOs would jump into the space. Unfortunately, that is not the case. And they're not really catching a broader institutional bid, for want of a better word. And therefore, they're far too small and highly illiquid. So what we are seeing right now is there's a small pool of institutional investors that are investing in cannabis. And then you've obviously got the kind of broader investment base, which is retail. What is happening right now is that small pool of institutional investors, they're choosing to invest in the MSOs. That broader pool of retail investors, they're choosing to invest in the MSOs purely because the fundamental growth outlook is more compelling. And so we've not seen kind of these ancillary names appeal to broader institutional investors like we'd hope them to. I think that then comes with safe banking. And I think critically within that, while you'll see kind of a small pool of institutions jump in that can't right now, I think from when we just spoke about before, there's also going to be a wider pool of institutions that won't still touch the MSOs. I think safe banking could be enough for them to actually want to get exposure. And the way they can do that if they can't do the MSOs is these ancillary names.
Yep, that makes total sense. And I think even for retail investors, right, even there you have, I think, a lot of retail investors who won't invest in the space. And of the ones who will, a lot of them got burnt very early on when, all these micro cap companies were going public on the CSE and, they were getting crazy valuations too. So it's kind of been this perfect storm that I feel like has really suppressed a lot of the demand that should be priced into these cannabis stocks.
Yeah, for sure.
And so would love to get your thoughts on, the most recent market downturn, as we've seen rising concerns of inflation and geopolitical conflict that's really spilled out into the stock market as a whole. I'm curious to get your thoughts on, do you think that cannabis relatively has sold off an appropriate amount relative to how the growth has actually been performing over the last couple quarters?
First things first, cannabis stocks were too cheap anyway. They didn't reflect fundamentals, and so they were too cheap, and they become even cheaper. Then specifically, with that in mind, when looking at actually the relative performance, then yes, you have seen a period of derating, which is correlated with a period of sequential declines on the top line over the last few quarters in the cannabis industry. While at the same time, we've also started to see some pressure on margins as well. My problem with this, though, and my big issue with this is cannabis right now is the only sector I'm aware of where it keeps getting assessed on a sequential basis. I think we need to start looking at things on a year-over-year basis. And so, yes, there's been a sequential slowdown, but if we look at year-over-year delivery, sales growth in 2021 across our coverage was over 80%. We still expect sales growth in 2022, despite all the pressures that everyone's talking about, of over 30%. And then on EBITDA, so there was growth in our coverage of over 100% in 2021, and then we still expect this to be up over 20% in 2022. So this is still way ahead of what we're seeing in most, if not all, other sectors, and it's especially attractive given the current macro backdrop we just spoke about.
Yep. Well said. So, of the landscape of public multi-state operators today, how do you think that that's going to evolve as the industry matures, right? Will we see all of them be winners? Will maybe some fail? Will there be more consolidation? Will more privates go public? What do you think?
I think further consolidation is natural. So if you look at any other consumer goods space, it's highly consolidated, and there's no reason to think that cannabis will be any different. So that, I think all the current large MSOs will survive, but not necessarily as independent, with many or a number of them likely to merge in the future. And we've already started to see moves that way anyway. Cresco, Columbia Care, a very recent example. I also think that we'll increasingly see a large number of smaller operators cease to exist. This is not just about the ability to get funded right now. I also think that this will happen even if we see capital market protections and better access to capital, and supply and demand forces start to balance, because there's simply too many companies relative to demand now, in my view. I think the hope for some of these smaller operators is if they get bought or merge with some of the larger players. But to do this, I think they need to offer something very strategic, such as strong branding or unique IP. And I don't think it's simply a case of being in a certain state anymore, which has been a driver of deals in the past. And to that, I think most MSOs now have their footprint where they would like it. And if they are going to expand right now, I think they'll do this through larger mergers so they can rapidly increase scale and potentially even realize overlap and cost savings.
Yep. That makes a lot of sense. And I want to touch on something you mentioned, which I think is so important in the cannabis industry in particular. And you talked about in today's environment where access to capital is very restrictive. And, that's, I think, one of the common themes we've seen throughout our time in the cannabis industry is that capital markets are pretty much always pretty tight, at least have been so far. But I think that's even amplified over the last couple quarters. So would love to hear your thoughts on how are you seeing companies adjust strategy to fit that environment?
I think number one, you're seeing larger mergers, so there can be increased scale. I think what you are notably seeing now is a focus on brands, a much greater focus on brands. I think over the last couple of years, many of these companies have had it too easy. I think anything they put on the shelf was being sold. It was like selling ice in the desert. I think you are starting to see pressures build up now. I mean, to my point earlier, even many of these limited license states, there is increasing evidence of oversupply, and we're finally starting to see competitive pressures pick up. And so you are really starting to see now a big shift in terms of really managing the P&L more closely, really managing costs, really getting the cultivation dialed in, not in terms of cost structure, but also quality. And now increasingly taking measures to really start to think about actually building brand equity and building long-lasting brands, which I don't think was the case before.
Yeah, I certainly agree. And, it's exciting to see them really put a focus on brands more. That's where we think there's going to be a lot of the long-term value is, you really start to build that consumer loyalty. You have consistent product, your products available in multiple states, et cetera, et cetera, et cetera. One thing I wanted to ask you about on a similar vein is you talk about, people buttoning down the hatches and focusing on margins. With the broader recessionary environment over the last couple of quarters, it feels like there's a broader economic slowdown combined with inflationary fears. How has cannabis been holding up? Have you seen, much change in consumer preferences or anything like that?
Within the context of an inflationary environment, I continue to like cannabis for a number of reasons. Firstly, it's probably the only consumer goods sector where we're not seeing price increases, and that's a reflection of the increasing competitive environment that we just spoke about. So that's keeping a lid on price increases. Second, I would argue it's more of a staple spend as opposed to discretionary for many consumers. So when you think about meals out, drinking, etc., consumption of cannabis is probably going to be one of the last things that consumers cut back on. And we are kind of seeing evidence that is the case. And even if you think about that, if there's more time spent at home and not going out for dinner, then it's likely going to mean more occasions to consume cannabis. And that's a trend we saw during COVID, obviously, which gave cannabis volumes a big boost. And then finally, number three, it's got a very strong industry tailwind, which most other sectors don't have, obviously, with new states opening up. So, with increasing inflation concerns, given the trends we've been seeing, given the likely ongoing trends with further states opening up, I do think it looks a very strong investment. But that comes to the case, even though it looks a strong investment, until we see capital market protection, it's probably not going to do anything for valuations right now.
Yeah. That's a really interesting insight. And so I think, My last question for you is, as we wrap up the conversation today, I think it's the $1 million question that everyone always asks, right? We talked about safe banking as maybe more near-term regulatory change. What are your thoughts on federal legalization?
I think that's probably a number of years off. So, I mean, I probably can 4 or 5 years at least. Personally, whether I'm right or wrong, I don't know. I think it's going to be more a kind of tale of incrementalization, if that's even a word. So I think we see something like safe banking, then potentially something which kind of maintains state rights. Then we potentially kind of see full federal legalization of medical cannabis even. And then finally, we potentially see kind of full federal legalization of recreational cannabis. I think the important thing to bear in mind with that, however, is if we do see capital market protections near term and institutional money come into the space, I think long-only institutional money, I mean, a lot of these guys, I mean, they're called long-only, they're taking a 5, 6, 7-year view. They will care about the companies that are them setting themselves up for that long-term success in a federally legalized environment. They will kind of take a view that kind of near-term margins, which are dictated by regulatory setups, etc., they're largely irrelevant. And so this is why I think it's very important right now, where there may be a temptation for some of these MSOs to focus on certain limited license states to protect margins. I think they've increasingly got to take a longer term view and start building the business for the longer term, because I think that's what institutions will care about, regardless whether they're not going to see federal legalization for 4, 5, 6 years.
Yep. At the end of the day, build a great business, generate positive cash flow, and the rest will follow.
Exactly. Wise man.
Well, Owen, thank you so much. This has been such a blast. Really appreciate you taking the time to come on the podcast this afternoon.
Yeah, it's been awesome. Thanks for having me, Jordan.
Absolutely. Have a great rest of your evening.
Take care, man.